Thanks, Jared, and thanks everybody for joining us today. Just by way of background, a few months ago, in an effort to be presenting some timely and some useful information to our clients and to others, we surveyed some of our industry team leaders and asked, of the emerging topics these days, what are the most relevant and the most pressing to your client base? And we built this program based on their response, and you'll see here cloud computing arrangements, simplified accounting for goodwill, restricted cash flow presentation, along with the remainder of the list, were the topics that really emerged as the most relevant. We will be talking about leases and revenue recognition as well, which have been probably shouldn't be news to anybody these days. Those have been the big topics of the last few years, but with revenue recognition and with leases as well, these are no longer issues that we're looking at years down the road. We really need to be making some decisions, and you need to be making some decisions now. And so the focus of the presentation today will be some of the practical implementation considerations. And finally, in the wake of the Tax Reform Act, Connecticut enacted a Connecticut pass-through entity tax, which creates tax issues for corporate entities that historically have not had to deal with any tax issues for financial reporting purposes by virtue of their pass-through status. That's changing this year, and Tony is going to walk through how Connecticut pass-through entities will be impacted by this tax. And finally, there was a major court decision impacting the tax world, the Wayfarer decision. So depending on the business you're in and where you're doing business, this may change your tax exposure. And we'll be talking about that at the end of the presentation as well. So hopefully that's a compelling lineup for you. I would just reiterate one more time, as Jared said, if CPE is important to you, you do have to answer the survey questions as well as the survey that you'll get tomorrow. It would be a real shame to endure an hour of listening to us and not get the credit that you are anticipating. So please be sure to attend to that. And finally, I would say, as you listen to us presenting, you're listening to our perspectives. We don't represent the FASB. We're not in a position to give authoritative guidance, but we are addressing these issues as we see them. And hopefully, to the extent that it prompts follow-up questions and conversation, you'll pursue that with your advisors and with your engagement teams. And with that said, I will pass it to Matt Coit, who will start with cloud computing.
Thank you, Marcus. What we'd like to go through first is cloud computing arrangements, some of the current accounting challenges, as well as some of the newly issued guidance that's kind of aimed to address some of those challenges. Just to start out, to illustrate some of the complexities in this area, I'd like to start with an example. You have a manufacturer that's transitioning from an in-house software system to a cloud-based computing arrangement, such as a NetSuite. This is a very common software as a service type arrangement. And oftentimes, the company will have large upfront costs towards this transition, and in some cases, some annual license fee thereafter. A lot of times, this implementation cost upfront includes things like setup, buying various modules for the system, reformatting data, project management, training, things of that nature. And those costs can be quite large. The main question at hand here, though, is whether or not those implementation costs should be capitalized, or do you look at this as more of a service contract where much of the cost would be expensed? And so, what does GAAP have to say on all of this? The current accounting came into play in 2016 with ASU 2015-05, and per that guidance, any fees paid in cloud computing arrangement would be capitalizable if they meet the two criteria that you're seeing on your screens here. The customer has to have contractual right to take possession of the software at any time during the hosting period, and most importantly, this is without significant penalty, or that it's feasible that the customer run the software on its own hardware or contract with another party unrelated to the vendor in order to host it. The issues being here is that in many cases, you don't have contractual right to take control. You're not actually getting a license to use per se. You're really just paying a fee, even if it might be billed as a license. And you certainly, in most cases, can't run the software on your own hardware. So in the example that I had just put forth, based on the existing guidance, this would have led to those initial implementation costs being expensed, which for certain companies would have been a large hit in any given year. And it's certainly causing a mismatch between pairing the cost of the arrangement with the benefit that was to be received. So this, what had come about was ASU 2018-15, and this is just recently released, trying to seek to address this issue. And what this does is this was largely accomplished through a change in definition of the term hosting agreement. Under the previous guidance, the concept of a formal license came into play, as I mentioned, and it very commonly doesn't occur that you'll obtain this license, since that's really the cornerstone of these software as a service business models. So what this change in definition did is it's changed to discuss just the use and access by a customer on an as-needed basis. And so what it's really doing is just widening that definition to include situations just like the one I've just described here. And as a result, those typical costs noted can now be capitalized in the same guidance under Section 350-40 for internally developed software. Certainly that doesn't mean that all of those costs can be capitalized. If you have costs associated with the preliminary project stage, with post-implementation, those things would still be expensed. But many of those that are involved with the application development stage, those would be tracked and assessed for allowability to be capitalized. And I would say, again, in the example I put forth, the majority of those costs would likely be allowed to be capitalized under this new guidance. The next question that comes to mind is, what's the treatment of these costs if you capitalize them? And particularly with some of these contracts, they might just be one-year recurring contracts. So would you just be amortizing over that period? They do look to address this with the guidance as well. And in addition to any non-cancelable period of the arrangement, you would also be including any options to extend if it's reasonably certain that they'll occur, whether or not the option to extend rests with the vendor or the customer. Conversely, if there's termination arrangements that are reasonably certain to be exercised, you would consider those as well. So that would help you to amortize those costs over the reasonable period which you'd be receiving the benefit of that hosting arrangement. As far as effective dates go, public companies, the amendments of this would be effective for them for fiscal years beginning after December 15th, 2019. With all other entities, they'd be for reporting periods beginning after December 15th, 2020, and interim periods within annual periods beginning after December 15th, 2021. Though early adoption of this is permitted, so certainly if the situation came up and you think that this would be a good fit, you could early adopt this. And the application could either be retrospectively or just prospectively for all implementation costs incurred after the date of adoption. So I'm just going to pass it back to Marcus to take us through simplified accounting for Goodwill.
Thanks, Matt. So this change that Matt just presented really, in my mind, falls into the category of changes that are really improvements in the financial reporting. In my mind, they don't all fit that category, but this one does, and it really cures some inconsistencies and some problems between accounting for software-related costs, particularly with the upswing in software as a service. A lot of entities would have been expensing costs that really would have been capitalizable had they simply obtained the software under different arrangements. So that has now been solved. Accounting Standards Update 2017-4, Simplifying the Accounting for Goodwill, is another attempt by the Financial Accounting Standards Board, the FASB, to simplify accounting. And for those of you that have Goodwill on your balance sheets and are familiar with current impairment testing requirements, you may be familiar with the current two-step process. And simply put, impairment was evaluated using a two-step process. The first step being that the excess of carrying value of a reporting unit over its fair value would trigger a second step calculation. And the second step of the calculation was really expensive. It was burdensome. It essentially required a fair value exercise that was similar to a purchase price allocation that you would undergo in the context of a business acquisition. And that might include, for example, for purposes of the test at least, recognizing intangible assets that weren't even recognized on your balance sheet for financial reporting purposes. So cumbersome process and an expensive process. And what this update essentially does is it eliminates step 2. And so let's just jump right in to look at an example of how that might impact your assessment of impairment. So here we have an example of a client that's got a book value and fair value in the left and right columns here respectively. And what you can see is that the total assets are $1,300, total liabilities $1,400. So the entity actually has an accumulated deficit of $100. As they work through their two-step analysis, we can see that their assets at fair value are worth $1,500. Their liabilities are still $1,400. The fair value of this company without goodwill is $100, and we've done an analysis and determined that the fair value of this reporting unit is in fact $200. So under the old two-step method, you would take a look at the fair value of the unit of $200, compare that to the fair value without goodwill. You would determine that there is goodwill impairment because the 200 exceeds the 100. We need to write down the goodwill to its implied fair value of $100. It's currently on the books for $300, so we would have impairment of $200 using the old guidance. Under the new guidance, we would say that the fair value of the unit is $200. It's actually in a deficit position of 100, so the fair value exceeds its carrying value, and there is in fact no impairment in this case. End of discussion. So that is a simplification and hopefully solves the need to do some complex fair value work. Now, one issue to be aware of is a situation where you're impairing goodwill and understanding the tax effect of that impairment. So again, let's take an example. Suppose you had an entity that had a carrying value of $1,000. Its fair value is $900. I suppose this is pre-tax reform because the tax rate is 40%. We would look through this under the existing rules, and we would say that because the carrying value, the fair value exceeds its carrying value, we have to write down goodwill by $100. So if we do that, immediately it would seem that we've solved the problem because now our carrying value equals our fair value. However, by virtue of the fact that we've written down that goodwill, which is amortizable for tax purposes, we've created a $40 tax benefit in the form of a deferred tax asset. So now when we book that asset, our carrying value goes up to $940. Compared to our fair value of $900, we have another $40 problem that we now need to address. And so how is that done? Essentially, you would apply this formula, which addresses sort of the circular notion, the circular nature of this calculation, and you end up with an impairment loss that's actually $167 rather than $100 and a deferred tax asset of $67. So you can still elect step 0, which is a qualitative assessment of goodwill, and that's determining is it more likely than not, based on qualitative factors, that goodwill impairment exists. That is still an option. This update applies to all entities. The only issue is that if you have elected other private company accounting pronouncements that allow you to subsume certain customer-related intangibles into goodwill, you have to just explain and justify why this change is an improvement in financial reporting. And our effective dates, the third bullet there, all others for the non-public business entities, including nonprofit entities, would be fiscal years beginning after December 15th, 2021, but early adoption is permitted, and we are in that zone now where you could adopt this pronouncement if you so choose. With that, I will hand it back to Matt.
Thank you, Marcus. The next topic we'd like to cover is going through restricted cash and the statement of cash flows. And the objective of this ASU is really to address the diversity in practice that's currently seen in the industry as to how restricted cash is being presented on the statement of cash flows. Prior to this standard, treatment really varied, and depending on the industries, depending on the different accounting practices, and there was really limited guidance onto the classification of these items. Outside of maybe the not-for-profit world, which has a little bit of guidance on it, there really is not much for the remaining industries. As a result of this, what was being seen in the statement of cash flows is entities are classifying these transfers between cash and restricted cash as either operating, investing, financing activities, a combination of all those. It just really resulted in diversity in both from a classification and a presentation standpoint. And it's causing issues with clarity and comparability both between companies and the industries. And so this ASU is really seeking to address that. Under ASU 2016-18, it provides clarification as to what should be included in the statement of cash flows. And you'll see the definition here. The statement of cash flow should explain the changes during the period for total cash, cash equivalents, and amounts generally described as restricted cash or restricted cash equivalents. So what they're getting at here is they want to include all cash in the statement of cash flows, restricted and unrestricted, as part of the cash balance that ends up getting reconciled from the beginning to the end of the period, and not just excluding those or showing those in another category. Certainly the next question that comes up a lot is what happens then with any cash that's transferred between an unrestricted and a restricted cash account. Essentially, those won't be reported on the statement of cash flows. They're looking at cash for all intents and purposes as a singular balance and not as two separate, a restricted and not restricted component. This does have some disclosure implications, though. So, and the first part I would say is largely included in financials already. It's just the restrictions on any cash or cash equivalents should be included in the disclosures, describe what they are. The second part, though, is it could be a change for some folks, and that would be if the statement of cash flow cash balance is different from what's on the statement of financial position, there should be a reconciling note somewhere, something to bridge the gap between what's being shown on the statement of cash flows and just the straight cash balance that's on the statement of financial position. And they offer two formats for that. You could either do a tabular or a narrative format. This is effective for public companies with fiscal years beginning after December 15, 2017. But in non-public companies, it'll be for fiscal years beginning after December 15, 2018. And early adoption is permitted, and a retrospective adoption would be the method. Again, similar to the cloud computing arrangements, this is actually a good standard, kind of helps improve on the transparency of the statement of cash flows between different industries, different companies, and really just provides that one format that should be used going forward. Now back to Marcus to take us through recognition and measurement of financial assets and financial liabilities.
All right, thanks, Matt. So this next topic is part of an ongoing project that the FASB has undertaken in the wake of the crash of 2008, and they really have been trying comprehensively to evaluate the quality of financial reporting and determine what improvements might have made statements and the information provided by issuers more relevant, would have helped people anticipate what was coming. And this particular standard, ASU 2016-1, is one of the products of that group. And in addition to improving the transparency and the quality of financial reporting information, it also meets the FASB's goal of continuing its convergence exercise with international financial reporting standards. It may be impactful for you depending on your situation and what information you think is useful for users of the statements. What the main provision of 2016-01 is that if you hold equity investments, and we're not talking about equity method or subsidiaries that are consolidated, but actual equity investments, including stocks, for example, they will continue to be measured at fair value. But currently, if you've got available for sale securities where the change in the unrealized gains and losses is flowing through comprehensive income, those changes in unrealized gains will flow through earnings and become a component of net income. So if you've got a significant portfolio of available for sale securities, this may change. This will change the way that activity is reported on your P&L. And if net income is a significant component in a debt service coverage ratio or a covenant of some sort, you'll want to make sure you're anticipating the additional volatility that this could create, and make sure you're working through those issues with the bank. A lot of entities that currently have, nonprofits, for example, have unrealized gains and losses flowing through earnings already, or their equivalent, and a lot of them have specifically carved that activity out for calculation purposes when it comes to debt service coverage ratio. So if this is going to be a new concept for you, that's certainly something that you'll want to consider. Other elements here, if you've got an equity security that is not readily it doesn't have readily determinable fair value, you've got to do an impairment assessment, but you can perform a qualitative assessment, which is very similar to the performance of the assessment for goodwill, which is you're looking at qualitative factors that may indicate that the security is impaired, and if so, writing it down if it's more likely than not that impairment exists. There are some other simplifications here as well. The requirement to disclose the fair value of financial instruments measured at amortized cost. So this could be bonds that are held to maturity, for example. That goes away for non-public business entities. And for public business entities, that are providing those disclosures, some of their discussion of the assumptions that they used in preparing those disclosures go away as well. So that's good. And there will be some disaggregation. I don't know that this really constitutes a major change, but if you've got you will be presenting separately in comprehensive income any change in the fair value of a liability that is the result of instrument-specific credit risk. So I don't think that's going to be a widespread change. And finally, on your balance sheet, there will be separate presentation of financial assets and liabilities to try to group assets and liabilities by their form. So again, to me, that doesn't seem terribly earth-shattering. The big change is that the geography of the changes in unrealized gains and losses moving from other comprehensive income to net income. For non-public business entities, this is effective for fiscal years beginning after 12/31/18, so it's coming. And again, looking prospectively, if this is going to have a significant impact on your covenants or the way that users of your financial statements view the bottom line, the time to start those conversations is now, and you can early adopt if you so choose. Now back to Matt for one of the big two topics of the last several years, being leases.
Yes, and this is certainly one of the bigger topics that we'll be talking about today. And I would say it would have one of the larger impacts on probably most entities. Just by way of background, ASU 2016-02 was issued in February of 2016. And this is really the result of a continuous push by the accounting world, both the SEC and FASB, to ensure that all contingencies and commitments are properly represented on the financials and just to improve the clarity and quality of those financials. And the new guidance is really a step in this direction. And like I mentioned, this one is incredibly impactful. What it's essentially going to be doing is bringing operating leases onto the balance sheet, along with how capital leases are currently presented, with a few other minor changes in there as well. Just as a frame of reference, from a public company standpoint alone, it's estimated that this is going to bring, as far as just bringing operating leases onto the balance sheet, it's going to be bringing about $1.2 trillion in new assets and liabilities onto the books. So certainly not a small impact here. And certainly for private companies, this implementation is right around the corner. Any entities presenting GAAP basis financial statements, it's for years ending 12/31/20. And as you'll see here shortly, it's not going to be any small chore in order to make this transition. So from a transition standpoint, there's a modified retrospective approach, which is it's a retrospective light, so to speak. It really means that as of the point in time of implementation, any leases on the books will be recorded based on this new guidance as of the balance sheet date. You're not going back to any leases that have already ended, anything like that. It's really looking at what's in place as of the balance sheet date. Of course, this does bring in a couple of wrinkles. So, for the year end at 12/31/20, any leases with remaining balances as of year end would need to be presented in this way. But for comparative financial statements, you would also need to be tracking this information and really have implemented this as of 12/31/19 in order for those financials to be comparative. So that's why it's really important, and we really just want to urge you now that this is something that needs to be worried about sooner rather than later. And hopefully this isn't news to any folks, since, especially with comparative statements, you'll really need this information starting for 2019. So just to get into some of the current accounting and the changes as to what this is going to end up entailing for most of us. Under current accounting, capital lease, just as a reminder, has one of four criteria. There's either a bargain purchase option at the end of the lease, the asset title transfers at the end of the lease, useful life of the assets approximately 75% or greater of the lease life, or the present value of minimum lease payments is in excess of 90% of the cost of the asset if you were to go out and purchase that. And if you meet one of those, it's recorded into fixed assets, disclosed separately, and there's a lease liability that's presented. Currently, the operating leases are really only shown in the footnotes. You'll have length of contract, the type of the equipment that's being leased, payment structure, timing, and all those amounts get recorded as a rent expense. Certainly, there's future minimum lease payments disclosed as well, but it's really just all put into the footnotes, and there's perhaps not as much transparency as you might like with these arrangements. Under the new guidance, this is going to change dramatically, particularly for, as I mentioned, operating leases, which those will be brought onto the balance sheet. I'll be going through the details of that shortly. But these are going to be applying to items that show up very commonly in lease arrangements and certainly are probably showing up on most of your books as well. And you can see it's going to be applying to property, real estate, land, equipment, really any contract where there's control of an identified asset that's being transferred for consideration. And there's also several items that you'll see here that it doesn't apply to. That bullet, though, where it's talking about contract where control of an identified asset is transferred for consideration, it's really kind of, it's opening up that definition of a lease, and we'll be going through that shortly. As you'd imagine, some of the more highly impacted industries are going to be those with many, many operating leases on the books, or all leases in general. And some of these are the ones that we've seen thus far in practice just from reviewing our client base. Certainly manufacturing clients, auto dealerships, airlines, really any company or industry that's got multiple locations, multiple leases. Those are the ones that are really going to be heavily impacted by this. It's certainly not limited to these, but from our initial conversations with clients, this is what we've seen has been most heavily impacted thus far. You'll hear me say finance leases interchangeably with capital leases. Under the new guidance, that's how they refer to them. They're essentially the same now. So if I do say one or the other, that's what I'm referring to. Under the new guidance, they're essentially putting both those and operating leases on the balance sheet, though, and they record those as right-to-use assets and corresponding lease liability. There is still a difference, however, between the two, and there needs to be a distinction between the two in the financial statements. So because of that, the criteria for what is a capital lease, what is a finance lease, remains relatively the same with just one addition. So you'll see the first four items here are the same as what we just spoke about. Item number 5 is a new item, and it's what it says is the underlying asset is such a specialized nature that it's expected to have no alternative use to the lessor at the end of the lease term. Essentially another case where there's just such a custom asset built that there's really no other way that it's going to be used by anyone but the person that it was leased to. And so if any one of those criteria is met, then you have yourself a capital or a financing lease. And if none of those are met, that's when you have yourself an operating lease. As with anything else, there's certainly exceptions. In this case, it's any leases with terms of 12 months or less, though they do consider renewal options. Similar to what I had spoken about with the cloud computing arrangements, it bases it on the concept of being reasonably certain. So if you're reasonably certain that this lease is going to be exercised, if a renewal term is going to be exercised, you would consider that within the term, and you couldn't just say, oh, it's an annual renewing lease. Not necessarily. You have to look at it a bit more qualitatively. So the first step, as you might imagine, is to determine if a lease exists. And under the previous definition, it was really just an agreement conveying the right to use property, plant, or equipment for a stated period of time. The new definition, you'll see, it opens it up a little bit. And as a result, I think what we're expecting to see is certain items being classified as a lease that were not previously under the former guidance. Certainly, contract title does not dictate a lease. It can be explicit or implicit, and it can also be embedded in any document. So, again, not to say that you're going to just be seeing something that says lease agreement. You might have something currently embedded in a document that actually ends up being a lease under the new guidance. What it's really getting at, though, is does the lessee have control of the asset, and are they receiving most of the power and the benefit of it? That's really what it's trying to get back to. And that's what it's really placing emphasis on. So from a capital lease perspective, the recording of this on the balance sheet is you have a right to use asset and a lease liability, and that's going to be measured at the present value of lease payments on the balance sheet. From an income statement perspective, you're going to have interest on the lease liability separately from amortization of that right to use asset. And then on the statement of cash flows, you'll end up having that broken out between financing activities and operating activities. So relatively similar as to what it was before, but just important to see the distinction. For an operating lease perspective, you'll have a right to use asset and lease liability as well. But on the income statement, you're going to have a single lease cost that gets allocated over the lease term and as this term lease expense. And so a little bit different from what we see on the capital lease side, and generally done on a straight line basis. Statement of cash flows will also differ, and those are going to be basically considered operating costs in all cases. This next slide here just serves to show you the comparison between the two, just as way of reference. But the balance sheet presentation, it's important to note that you cannot be consolidating these into one line unless you have them broken out separately in the notes. So again, it's just important to maintain that distinction between the two and not just be consolidating them into one bucket. Some other items of note, the lease term for that right of use asset liability is that initial non-cancelable term plus optional periods that have a reasonable chance, that term coming up again, of being executed as of the lease commencement date. So it's very similar to what we spoke about during the cloud computing arrangement accounting, but what you might have is a case where as of the lease commencement date, you weren't reasonably certain of something being executed, and that changes down the road. Certainly those lease modifications need to be assessed, and in some cases it may actually be accounted for as somewhat of a new lease, a spin-off lease, or you might just be remeasuring the existing lease. So something to keep in mind there. From a lessor perspective, that accounting remains largely unchanged. This has certain implications from a related party standpoint. Certainly I know from my experience, I run into a lot of them that they just don't have any sort of formal contractual terms, or there's no agreement in place. I would say for the majority of these, we would recommend that a formal agreement be written and put into place. The guidance really talks about legally enforceable terms of an agreement if one exists, and it's certainly easier to have that in writing than just a verbal agreement. A couple of other items to keep in mind. These items really should be looked at from a qualitative perspective. So certainly if you have leasehold improvements on related party leased property, for example, that have been capitalized for an extended period of time, say 20 years, it wouldn't make sense that you could have a month-to-month land lease because there's a mismatch there between the two. It's important to look at these things kind of holistically, all those items together, and we would certainly encourage getting those agreements in place if there isn't a formal one already written. The last main item I wanted to cover, and this is perhaps one of the largest impacts, is talking about the debt covenant considerations. And as we've talked about, from bringing those operating leases onto the books, you're going to be seeing an increase in assets and liabilities. And so there's an impact there that you're likely to see on debt to equity ratio, current ratio, leverage ratios, et cetera. And it's part of the reason why we really have been urging people to be proactive about these. 9 times out of 10, you should be reaching out to your lenders early because they're not necessarily aware of this. I know, we've done a number of presentations to financial institutions, lending institutions, and in many cases, it's been news to them. So I certainly wouldn't operate under the assumption that they're taking care of this on their end. You can't just assume that they know and they're adjusting the covenants. Some of the options that have been proposed that we've heard about is this concept of frozen gap, essentially saying that new leasing liabilities would be excluded from the covenant calculations, and that calculation would really only include figures that were consistent with GAAP at the time of the loan agreement being executed. So short of a full modification of the covenant agreement, that's an option as well. But really just urging people to work with lenders now before it comes time to move all these items onto the balance sheet and end up having an issue. Just by way of example, and I think this really serves to drive it home for a lot of people and just kind of shows the magnitude. Say we have an operating lease that's meeting these criteria. It's to have 5-year terms, $20,000 a month, interest rate of 4%, no residual value or other costs noted. What we have on this next slide is showing you the balance sheet after we brought the operating lease onto the books, and it's showing you some of those ratios that we had mentioned along the right side. You can see the debt to equity ratio to start. Prior to the implementation, we had a debt to equity ratio of 0.7. Post implementation, debt to equity was 1.4. So, if you had a covenant that stipulated you needed to be below 1, you've just failed overnight without really anything changing outside of the adoption of this, new guidance. The same thing goes for the current ratio. You'll see, prior to the implementation, you have 3.46. After the implementation, you have 2.6. So if you had to maintain a ratio of above 3, you've again just failed overnight without really anything changing other than the adoption of this standard. So this is why we've really been stressing to look at these things sooner rather than later. Similar changes could be seen in interest expense. If say you have new leases that are meeting the new definition from a capital lease perspective that are brought on, that could increase the interest expense. So the point is if you do have these types of arrangements, any leases, this will have an impact on you, and it certainly could have an impact on any financial covenants that you have in place. And so it's really critical that folks are proactive in reviewing these and working with lenders early. Just some closing considerations with this standard. The point here is that this really will have a large impact on essentially any companies with leasing activities. There's a lot of costs up front in order to prepare all the information, as well as going forward and upkeep all of it necessary for the disclosures, both from a time and a personnel perspective. And you almost need, depending on how many leases you have, to have some sort of inventory of leases kept in order to track all this information. Certainly, if you have leases in multiple locations and there's decentralized accounting, this could get really cumbersome and more complex. There's also added complexity between the classification of operating and financing, and there's different accounting and disclosures for both. So, added complexities there as well. And just to reiterate, for the balance sheet presentation, you cannot present the finance leases and operating leases on the same line, or if you do, you must break that out in the notes of the financial statements. So certainly not enough to just drop them all in the same bucket. Certainly more disclosure within the footnotes as well. So I would say our parting message on this topic is really just to be proactive into looking into covenants, working with your accounting department and accountants to compile, assess, review all this information. That way, when it comes time for implementation, there isn't a shock on your end, lenders' ends, things of that nature.
Okay, so moving on to revenue for contracts with customers. And you cannot really do this topic justice in the few minutes that we have. I'm going to give a quick overview so that people are, again, hearing what the main provisions are. But I also want to make sure that there is a sense of urgency in your minds with respect to this topic if it wasn't there already. And I'll explain why in just a moment. We've been looking at this, I think a lot of people have been looking at this as a change that if it's going to impact you at all, its impacts are down the road. And for reasons that we'll explain here, that's no longer the case. This one is upon us, and it's time for people to be making decisions. So the FASB's guide, their objectives here were to converge with international financial reporting standards and also to create one common framework that all financial statement preparers would follow when recognizing revenue, whereas currently if you're a contractor, you may follow one model, software another, other service providers their own models. This is one model that regardless of the industry you're in, if you're recognizing revenue, you will follow this model. The core principle is fairly straightforward. Revenue should be recognized as goods and services are transferred to customers. It sounds fairly straightforward. The thing to keep in mind is that it took the FASB over 600 pages to articulate how to implement this fairly, on the surface, maybe a straightforward concept. Here's the key, and if during this discussion you take nothing else away, this would be the key, is to be mindful of the effective date. So non-public entities, the implementation period is periods beginning after December 15th, 2018, and you may elect early. So if you're looking at that, you think, well, that's calendar year 2019, so why are you being alarmist about this? And I would just point out that there are two transition options. Option one is a full retrospective application. And so essentially, if you flash forward to 2019 when you're closing the books, if you choose the full retrospective method, you'll be restating 2018. So as you close your books now, you should be thinking about that and understand the impact and the analysis that would go into that. Otherwise, it may be more cumbersome and more complex to revisit 2018 a year from now. So there are decisions that you really need to be making now as you close the books for 2018. Option two, in theory, is probably a bit simpler. You could do this as basically a single year in 2019 with a cumulative effect of a change in accounting principle at the beginning of 2019, and that would delay this for a year. The caveat there is you would provide financial statement disclosures that really articulate the impact of the change if you go that route in 2019. So effectively in 2019, you've got to close your books two different ways so that you can provide that information. To me, this is a bit of a silly slide. Who made an impact? Anybody with revenue. If you have revenue, you need to be thinking about the potential impact of this statement. And the model is, as we've said, a 5-step process. Step one being identify the contract with the customer, then identifying the performance obligations within the contract. What are your obligations? What have you promised to do? Determine the total price and then allocate it to the different performance obligations. finally, recognizing the revenue as you satisfy the performance obligations. And each one of those steps has its complexity. Step one, identifying the contract with the customer. You tend to have issues if you've got different components of an arrangement with a customer articulated in what appears to be separate contracts. It may all be one contract for financial reporting and rev rec purposes. If they were entered into simultaneously, are interrelated, and in substance are really closely related to each other. And the impact of that is you then have all the ensuing 5 steps, or the ensuing 4 steps, excuse me, will need to be considered. You can't just look at them as separate arrangements. The other issue can be if you're performing services for a customer where you don't yet have meet the criteria of a contract, and that could be certain services where collectability is doubtful, but you've elected to perform the services anyway, for example. Whereas now, if those payments are non-refundable, you may be on sort of a pay-as-you-go, recognize the revenue when you receive the cash type of a methodology. If you're in the absence of a contract, and this arrangement that I just described would not constitute a contract, you can't recognize any revenue until you're done doing everything that you need to do. So that may result in a deferral of certain revenue under the new standard. The other issues to think about here would be contract modifications and extensions. Those can get fairly complex. If the number of units, the time period, the price, if some of those items are modified midstream during the performance period of a contract, that can result in retrospective changes or prospective changes, or in some cases a combination of the two. So contract modifications are issues to be aware of as well. When it comes to step 2, identifying the performance obligations in the contract, the key is a performance obligation is something that has standalone value to the customer. And certain items may not currently be recognized as having standalone value that really should and would be under this new standard. If you have an equipment contract, an equipment sale, for example, and you offer support, parts, training, other ancillary services, you may not be separately considering those as performance obligations. And under the terms of the new standard, they may be, they may or may not, depending on the analysis. If they do qualify as separate performance obligations, the impact is that you'd have to defer a portion of the revenue and recognize it as those separate performance obligations are met. So this issue is key. The other item is certain obligations that feel like they may be separate performance obligations, in fact, are not. So an example of that might be certain software as a service arrangements where we get an upfront setup fee. It's non-refundable once we get the client up and running on our platform, and then we have some sort of a subscription service, and we'll recognize a license revenue over a year or 2 years or a license period. If that installation fee probably doesn't deliver standalone value to the client, that's no good to them except that they're using your platform. So you may have to defer all of that revenue and recognize it over the license period when currently you're looking at it thinking, well, it's non-refundable, I've done the work and the client's up and running, so we're good to go. Those are the types of issues that you need to think about here. Step 3 is determining the transaction price. The challenges here really come into play when you're dealing with variable determination, or variable consideration. And variable consideration can include rebates, discounts, performance bonuses, incentives, or penalties. Anything that may change the total amount of consideration that you expect to be entitled to needs to be very carefully analyzed, and so that you can determine when those estimates need to come into play. If you're recognizing revenue on a per unit basis, for example, but you've got a discount program, you may end up having to defer quite a bit of revenue in those earlier units because ultimately you expect that the customer is going to exceed the thresholds, benefit from the discount later in the contract period, and it definitely can change the timing of the revenue recognition. Step 4 is allocating the transaction price to the performance obligations in the contract. I think the most common misconception when it comes to allocation is if people are looking at the piece of paper, the contract, and saying that, yes, I have installation, I have a license agreement, and I have a service component, and the dollar amounts associated with each of those components is separately articulated and in the contract, I'm going to recognize revenue accordingly. And the answer is maybe, maybe not. It depends if those prices, as they're written in the contract, are truly reflective of the standalone selling price of each of those components. And if they're not, what matters is the standalone selling price of each of those performance obligations, not necessarily what's actually written on the piece of paper. And finally, step 5 is when do we recognize revenue? And again, this is really as services are provided, how is the customer benefiting? Do they control the asset? It's a major issue whether you're conveying value up front that the customer then has title to, or if you're providing service over the period. And it's a complicated analysis, and it can result in deferring revenue that otherwise would have been recognized up front, or perhaps in some cases recognizing revenue up front that you might have been deferring. When Microsoft implemented the RevRec, they had a big pickup in their revenue in the period of implementation because they determined that certain of their license revenue was a right of use license, and they were entitled to revenue right up front. So GE, on the other hand, had a big deferral of revenue. So depending on the nature of the implementation challenges, it can definitely go either way for you. And knowing that it may impact 2018, depending on your chosen implementation method, the time really is now to be having those discussions internally and with your auditors. And we finally, with disclosures, because I've got to turn it over here to Tony, who's going to talk about some of the tax issues. Basically, there will be much more granular detail about the nature of the different performance obligations and how the accounting works and why for each separate stream of revenue. And we have added here a plan. Again, this is from early stages, thinking about who's responsible for this on your team. Do they have the resources that they need? Are they forming preliminary conclusions and checking in with their auditors? At this point, you need to be making final decisions and confirming that with your auditor, talking about impact and what makes the most sense for you with respect to application. Do you expect to do this retrospectively? And if so, what's the impact on 2018 as you close the books? Or do you think prospective may be the way to go? So, Tony?
Thanks, Marcus. I guess the first question you should probably ask yourself is, what is a tax person doing in a financial statement presentation? Well, the next 2 state tax items I'm going to talk about could have a significant impact on your financial statements. And as a result, your auditors should be looking at these before issuing your financial statements. The first item I'm going to talk about is the Wayfarer decision, which is a sales tax collection issue. The U.S. Supreme Court in June of this year in South Dakota versus Wayfarer overturned over a 50-year precedent that said that a state may require a company to collect sales tax in their state if the company just has an economic presence. No longer is a physical presence required. So merely selling into a state could create an obligation for you as a company to collect the tax. The economic threshold that South Dakota used was $100,000 in sales or 200 transactions into the state. And the U.S. Supreme Court basically blessed that as significant nexus requiring you to collect tax in South Dakota. As a result, many states have passed laws to implement the same kind of thresholds. And the effective dates have ranged from July 1st of 2018 through January 1st of 2019. As of today, there are about 30 or so states that have enacted economic nexus thresholds. And it really affects all kinds of businesses and industries, whether you're selling service or software or products, tangible personal property, whether you operate in a corporate form or a pass-through entity form. it really doesn't matter. And as I mentioned, states have been aggressively passing these laws, and as of today, there's about 20 to 30 states that have enacted these laws. Congress, the U.S. Congress, has stepped in to try to mitigate some of the pain by passing some bills that either are against the Wayfarer decision or that are trying to simplify companies' compliance with the Wayfarer decision. However, those bills haven't really gone anywhere. As you can imagine, Congress is preoccupied with more significant issues right now. So what does this mean from a financial statement impact? Well, under ASC 450 or ASC 405, if you're not complying with these laws, there may be some reserves that might have to be accrued on the books because you did not collect the tax, and as a result, there may be some sales tax exposure, or at least there might be some footnote disclosure. So the takeaway here is to really understand what your obligations are in the various states that you're selling into, whether you meet these economic nexus thresholds, whether or not you have some other kind of physical presence whereby you should have been collecting the tax, and is there any exposure there. So that's the first significant state tax item that has occurred during 2018, the Wayfarer decision. The next item I want to talk about has to do with the Connecticut pass-through entity income tax. This is an income tax imposed on pass-through entities that do business in Connecticut, whether you're based in Connecticut or you're an out-of-state company that's doing business in Connecticut. Effective for tax years beginning on or after January 1st, 2018, these entities will now be subject to an income tax. And this was passed in response to the Tax Reform Act, whereby state taxes were limited, are limited to $10,000 at the individual level. This tax is meant to benefit pass-through entity owners by pushing that tax down from the individual level down to the entity level so that the entity would be able to deduct it, and in effect, the owners get the benefit of that deduction. There's no more composite return in Connecticut like there used to be. There's no more payments on behalf of non-residents like there used to be. It's simply now an entity-level income tax. And there's two methods to calculate the taxable income. One is called the standard method, and another is an elective method, which is called the alternative base method. We don't have time today to go through the methods, but it is something you should be discussing with your tax advisors on which method might benefit you and your owners if you operate in a pass-through entity form. When I say pass-through entities, I'm referring to S corporations, partnerships, and limited liability companies that operate as partnerships. So if you're a sole proprietor or a C corporation, this tax would not apply to you. There is an option or an election to file a combined return. So if you have pass-through entities that are related or affiliated through common ownership, and one has a loss, for example, and one has income, there is an election that could be made to combine the two entities so that the losses of one entity could offset the income of the other entity and mitigate this tax. The other requirement here for the pass-through entity tax is now estimated tax payments are required, and if payments are not made in the required amount, a penalty could be assessed against the company. So that's something to keep in mind, whereas before, pass-through entities didn't have to make payments. For 2018, because of the late nature of the enactment of this law, which was passed and signed by the governor in May of 2018, many pass-through entities and owners were caught off guard with this tax. So pass-through entities weren't aware, or still are not aware, that they have to make these estimated payment requirements to avoid penalty. So what the DRS is allowing companies to do is push down any owner estimated payments down to the pass-through entity. This is called recharacterization, so that those payments are deemed to be transferred to the pass-through entity and deemed to be paid by the pass-through entity for purposes of avoiding this underpayment penalty. There's a form that has to be filed with the pass-through entity and with the DRS by December 31st, 2018 to make this recharacterization election and to avoid the penalties. So again, what does this have to do with financial statements? Well, as Marcus alluded to at the beginning, you'll have to calculate a income tax provision for Connecticut tax purposes, whereas before you never had to. And in some cases, this could be material. Not only do you have to set up a current account, but you also will have to set up a deferred tax account. So there'll be a little bit more work involved. There'll be a little bit more study to whether or not this will be material to your financial statements. You actually may have to set up a deferred balance sheet account, a current payable account, and have the required footnote disclosure. So this could complicate the financial statement presentation as well. So again, I just wanted to spend a few moments talking about the Wayfarer decision and the Connecticut pass-through entity income tax. I previously did a webinar on each of these and for an hour long that kind of got into more of the detail. And if you're interested to know about any of these topics in more detail, you can go to our website and listen to those webinars. So with that, I'll turn it back over to Marcus with some closing thoughts. And thank you very much.
Thanks, Tony, and thank you, everybody who listened in. Hopefully that was useful. And if you need the CPE, again, hopefully you participated in the polling questions throughout the presentation, and keep your eyes open for the survey that you'll be receiving tomorrow.